In today's video, we're going to discuss as a home buyer, what are the options to put less than 20% down. We're going to explore insured mortgages, what is the mortgage insurance premium, and how you can qualify to actually purchase more than one property with less than 20% down, like a 5% down payment. If you're new to this channel, my name is Kokun and I run a real estate team and I work as a mortgage broker here in the Niagara region. If you're interested in learning more about what we do, check out some of the links in the description, or you can book a call with me to discuss your situation and see if there's any way we can help. All right, so let's get into it. So here I am on the CMHC website. That's the Canada Mortgage and Housing Corporation. There are actually 3 mortgage insurers that you can get mortgage insurance in order to purchase a home with less than 20% down. Now, the reason you need mortgage insurance when you're putting less than 20% down is that these mortgage insurers guarantee to the lender that if you stop paying for any reason, they will cover any losses the lender may experience. So as a result, you need insured mortgage in order to put less than 20% down. Now, on this website, like it says, the benefits are you can potentially get up to 95% of the purchase price in the form of a loan. The minimum down payment, if the home costs $500,000 or less, is 5%. If it costs more than $500,000, then you need 5% on the first $500,000 and 10% on the second $500,000. If the home is more than $1 million, you are not able to get mortgage insurance. It says the lender pays an insurance premium based on the mortgage insurance amount. So basically the way it works as a typical borrower is that you have a mortgage insurance amount, and let me see if I can find the exact amount here. So you can see here, this is what's called the premium for mortgage insurance. So you can see there's actually mortgage insurance even if you put 20% down. And many times when you get a typical mortgage where you put 20% down, the lender actually may go out and purchase mortgage insurance from CMHC on the loan that you purchased. In that case, you as the borrower don't really pay it. They do it for their own benefit. In terms of when you're purchasing a home with less than 20% down, you typically pay the mortgage insurance. But if you see here, it's quite a significant amount, right? 2.8%, 3.1%, and if you're going all the way up to 95%, the mortgage insurance can be as much as 4%. So imagine you're buying a house with a 5% down payment, and do you also have to pay 4% in a mortgage insurance fee? You do not. The way it works is that this 4% is actually added to your mortgage amount. So instead of a 95% mortgage, you get a 99% mortgage, and then you just make your regular payments based on that 99% value of your home. So you pretty much have a mortgage for the entire purchase price, but this allows you to put 5% down, and usually by the end of the first 5-year term, your mortgage has been paid down by more than the mortgage insurance, and you start building equity in the home. So let's go into some of the general requirements to get mortgage insurance. So standard stuff, obviously it's only for homes in Canada. It has to be less than $1 million. This is, again, it talks about the minimum down payment. You have to use it from your own resources or a gift from an immediate relative. You can purchase homes with between 1 to 4 units. I believe for 3 and 4 unit properties, you will need to put 10% down, but it is available. Here it talks about the debt ratios and it talks about the closing costs. One thing that it does not mention, and this is a very common misconception, you do not need to be a first-time home buyer to qualify for mortgage insurance. Let me repeat that. You don't need to be a first-time home buyer to qualify for mortgage insurance, meaning if you purchase a property with mortgage insurance, you put 5% down and you live in it. This is a key point. This does not apply for investment properties. 1 year later or 2 years later, you decide, hey, I don't like this home. I don't like this neighborhood. Just something about the home doesn't work for me. Maybe it's a little bit too far from my work. You need to have a valid reason. But as long as you have a valid reason for moving, at that point, if you go out and purchase another property, as long as you're intending to move in that property, you can then go back to CMHC and say, hey, I know I already own a house, but I'm looking to buy this other house, and here is the reason why. As long as they accept your reason, you're able to purchase a second or even a third property with 5 or 10% down. And you can sell the first property if there's equity in that property, or you can keep it as a rental, rent it out and keep it as a property that you own while you purchase your next property that you're going to move into. So I hope you found this video helpful, and I've gone a little bit into some of the details of the mortgage insurance, but this is one of the reasons why I personally like recommending, if you're purchasing your first home, consider properties that may have a second apartment, like a basement unit. It's called house hacking, where you live in one unit and you rent out another unit. The reason for that is, maybe in a year or two, if that house doesn't work for you, you have the option of selling it or renting out both units and then going to purchase the next property. And typically, if you have 2 rentals or even 3, you may be able to cover your expenses on that property, so you don't need to sell it. And then long term, if you have a couple of properties that you hold, that could be quite good for you financially. Hope you found this video helpful. Again, if you have any questions, feel free to comment down below or book a quick 15-minute call using the link in the description below. Until next time, all the best.